Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Okay, let's unpack this. Today's deep dive is all about cutting through the noise in the whirlwind of major financial headlines and market reports from August 14th, 2025. We've pulled from top financial publications like, CNBC, Yahoo Finance, Reuters, and Bloomberg. Our mission, to distill the most important nuggets of knowledge, what's really moving markets and minds today.
And what's truly fascinating here is just how interconnected these stories are. I mean, really connected. From the nuanced decisions shaping global economic policy all the way to corporate strategies playing out. We'll connect those dots for you, showing not just what happened, but why it matters in the bigger picture, and importantly, what you should maybe keep an eye on.
Right. Let's kick things off then with a crucial look at how global markets are doing. It's certainly been a mixed bag in Asia Pacific, wouldn't you say? Looking at the August 14th close, reports from CNBC showed, quite varied results. Hong Kong's Hang Seng Index, for instance, saw a drop of about 3.37%. Mainland China's CSI 300 was pretty much flat. And Japan, the Nikkei 225 declined 1.45%. That actually reversed some of its, impressive recent record gains.
Exactly. That's a clear signal of, let's say, divergent sentiment across Asia. But like you said, mixed. Because contrast that with Australia, their S&P/ASX 200 actually advanced 0.53%. It even hit an intraday high. South Korea's Kospi closed flat, and India's Nifty 50 ticked up just a bit, 0.12%. So some markets pulled back, others showed resilience, maybe different underlying currents or investor expectations at play there.
Okay, but here's where it gets really interesting, a compelling twist. Because in stark contrast to that mixed picture brought U.S. equities, they've been on quite the roll. Both Bloomberg and CNBC were highlighting this. Just yesterday, August 13th, the S&P 500 and NASDAQ Composite climbed again, new record closing highs. And it wasn't just tech. The Dow Jones Industrial Average also added a significant chunk, 1.04%. This euphoria on Wall Street, as Yahoo Finance called it, seems largely fueled by one big expectation: a Federal Reserve rate cut.
And that's really the heart of it, isn't it? It raises this important question for you, the listener. What's driving this divergence, between the somewhat subdued Asian markets and this U.S. rally? And maybe more importantly, how sustainable is the U.S. market's climb, especially with the Fed right in the spotlight? Investors are heavily betting on a Fed rate cut next month. But Federal Reserve officials are sounding a clear note of caution. Reuters reported on this. San Francisco Fed President Mary Daly, for example, she actually pushed back against a 50 basis point cut for September. That's 0.5%. Citing the strong labor market.
Right, so she isn't seeing the need for quite that big of a move. That directly contradicts some of those market hopes, doesn't it? But it's not a complete no, is it? Reuters also noted, while Daly supported holding rates steady last month, she would support a September cut. Because inflation pressures haven't been as stiff as feared, maybe, and the job market conditions have softened somewhat, she seems to favor a gradual recalibration over the next year or so. Not an urgent slash. It really sets up a fascinating tension.
It really does. You've got the market pricing in these aggressive cuts, while a key Fed official is signaling something much more measured. That's precisely the high wire act the Fed is performing right now. If they cut too slowly, they risk, stifling growth. Cut too fast, they could reignite inflation fears or maybe signal weakness they don't actually see. And adding another layer here, U.S. Treasury Secretary Scott Bessent is actively pressing for rate cuts. Especially amidst the search for a new Fed chair. There are reportedly 11 potential candidates on the list. So this external pressure from the Treasury definitely puts more eyes on the Fed's next moves.
It's such a complex dynamic. Market optimism clashing with some of the Fed's, more measured tones. And that brings us to another elephant in the room that directly impacts inflation. All the ongoing talk about tariffs. CNBC's Daily Open highlighted this. They noted that economists from major players like Goldman Sachs, UBS, JP Morgan Chase, they generally agree. Higher tariff inflation is coming. They expect consumers, that's you and me, to bear about 2/3 of the cost by the fall.
And this isn't just theoretical, is it? Despite President Trump criticizing Goldman Sachs for that prediction, Goldman actually defended its research. They asserted that if these most recent tariffs follow the pattern we saw with earlier ones, consumers will indeed feel the pinch. And we're already seeing businesses react.
The Bloomberg reported that the Port of Los Angeles saw its highest container volume in, get this, 117 years last month. Why? Shippers rushed to front-load cargo ahead of those anticipated U.S. import duties. Wow, 117 years. That's a direct real-world response to the uncertainty, isn't it? Shows businesses are reacting to these potential cost increases. But does this pre-tariff rush, does it actually intensify the inflationary pressure short term, or does it maybe smooth it out over time? It really makes you wonder about the ripple effects.
That's a great question. I mean, on one hand, you could argue it pulls demand forward, creating a temporary spike in activity, right, at the ports. But it also gives companies a bit of a buffer, allows them to potentially absorb some costs, maybe adjust supply chains before the full impact hits. This strategic behavior by shippers, it really indicates that while economists might have a consensus, the market's already pricing in and responding to these potential policy impacts. It's like a real-time stress test on global supply chains.
Okay, so we've seen how these global trends are shaping markets. Now let's drill down to some specific sectors where the macro shifts meet, micro realities. And when we talk growth right now, we absolutely have to talk tech and that relentless AI boom. Reuters reported that Foxconn, a huge player in electronics manufacturing, saw a forecast-beating 27% increase in Q2 profit. This was largely due to just robust demand for AI servers. And what's really striking here, for the first time ever, Foxconn's AI server revenue exceeded their smart consumer electronics revenue, like iPhones. In Q2, they're even planning over a 20% increase in capital spending, boosting server production in Texas and Wisconsin.
That's not just a number change. That's like a seismic shift in the company's core business, wouldn't you say? Foxconn, long synonymous with the iPhone, is now telling us AI is a bigger revenue driver. And it's not just them. Cisco, according to both CNBC and Yahoo Finance, also reported Q4 results that slightly beat expectations. And their AI narrative is solid. Their CEO stated they're getting more attention from major tech companies for the devices that enable AI. This just underscores how AI is becoming the central, transformative driver of growth right across the tech supply chain, pulling demand through from hardware to networking.
Yeah, absolutely. But the tech sector, especially chips, it isn't just about market demand, is it? It's also deeply intertwined with geopolitics. Yahoo Finance reported on President Trump's, unconventional chip gambit, as they put it. He announced a surprising 15% cut of sales on NVIDIA and AMD chips to Chinese companies, effectively allowing these chips to flow back into China. This is a massive shift. Remember, NVIDIA had to write off, $4.5 billion in Q1 and expected another $8 billion hit in Q2 from the initial ban. And AMD reported an $800 million loss in Q2 because of those restrictions.
This situation with the chips perfectly illustrates how geopolitical considerations are directly impacting corporate bottom lines and long-term strategy. Analysts seem to view this particular move as a short-term positive for the chip makers, right? Allows them to recoup some losses, re-engage with China's AI ecosystem. But immense uncertainty remains about future policy changes, national security concerns. The rapid shifts mean companies like NVIDIA and AMD are grappling with a highly unpredictable environment. And Yahoo Finance also noted Trump even met with Intel CEO Lip-Bu Tan after calling for his ouster just last week. It just shows how fluid and, frankly, personal these policy shifts can be.
Wow, yeah, whiplash. And speaking of areas with rapid shifts and high demand, the crypto market is certainly making headlines again. Yahoo Finance reported Bitcoin rose to a record high, $123,769. It's now up 31% year to date and an impressive 60% from its April lows. Key drivers. Seems to be a surge in institutional demand, growing bets on looser monetary policy, and notably the Trump administration's increasingly pro-crypto stance. President Trump even issued an executive order exploring allowing 401k plans to hold cryptocurrencies, which, if that happens, could open up a huge new avenue for mainstream retail investment.
Definitely. This institutional adoption, plus the potential for broader retail access, these are fundamental shifts for the crypto market. Gives it a level of legitimacy it hasn't always had. Fundstrat's Tom Lee, for example, he believes Ethereum, which also saw prices surge near record levels, is the biggest macro trade over the next 10-15 years. That's a bold statement. He highlighted that most Wall Street crypto projects and stablecoins are built on Ethereum's infrastructure. And its native token, Ether, is up more than 50% since the Genius Act legislation passed last month. That legislation itself, creating clear guardrails for stablecoins, that's a potential game changer for regulatory clarity in the space.
And you can see the confidence building. Further validating this renewed interest, cryptocurrency exchange operator Bullish Ticker, BLSH, saw its stock rise 90% on its first day of trading. That's according to Yahoo Finance and CNBC. It opened at $90, way above its $37 IPO price, valued the company over $10 billion. That really indicates the IPO window remains wide open for promising crypto ventures after some, let's say, challenging years for the industry. Okay, so we've just explored how investment interest is surging in speculative assets like crypto, perhaps fueled by hopes for looser monetary policy. But how do these broader economic shifts, coupled with geopolitical tensions, impact a fundamental commodity like oil, which often tells a very different story about real-world supply and demand?
Yeah, good question. Reuters provided some interesting insights there. Premiums for prompt benchmark oil prices, like Brent and Dubai, they're falling globally. This indicates a narrowing of backwardation. That's the market structure where immediate prices are higher than future prices, usually signaling tight supply. So the narrowing suggests the market now views supplies as, well, expected to rise, or at least be less constrained going forward. This is being attributed to rising output from the Middle East, Latin America, and Europe, just as we're seeing the end of peak summer demand approach.
Ah, okay. So it sounds like a bit of a supply-demand rebalancing act, which could potentially ease prices. And Reuters also mentioned that easing concerns over U.S. sanctions on Russia are contributing to this trend, too.
That's right. Citi analysts in particular suggested that Brent crude could fall to the low $60 if there's progress towards a U.S.-Russia ceasefire deal in Ukraine. That really shows how deeply intertwined global energy markets are with geopolitical events. A ceasefire could dramatically reshape the supply landscape and therefore prices.
Definitely. Okay, beyond the big headlines in major sectors, our sources offer some other interesting insights. Snippets into specific economies and corporate performance that help paint that broader economic picture. Let's look at e-commerce in China, for example. Reuters reported that JD.com beat market estimates for quarterly revenue, total revenue up 22.4% to 356.66 billion Chinese yuan. That signals pretty resilient consumer spending on its platform, fueled by deep discounts, government subsidies, and record sales during China's 618 festival, one of their biggest shopping events.
That's a remarkably strong performance for JD.com, especially given some of the broader economic pressures China has faced, right? It speaks to the ongoing power of domestic consumption and, well, strategic marketing. Now, shifting gears to India, CNBC Pro noted the Indian IT sector has actually experienced job cuts and sort of muted earnings. Companies like Tata Consultancy Services cut over 12,000 staff. That's about 2% of their global workforce, mostly in middle and senior management. The company attributed this to mismatched skill sets, while others cited automation as a major factor. Infosys and Wipro have also reportedly trimmed roles or slowed hiring. It really raises a crucial point about the future of work, even in booming tech hubs. Skills gaps in automation are real pressures.
That's a significant workforce adjustment in a key global tech hub. Yeah. Highlights the challenges of adapting. Moving over to Europe, Reuters detailed that the Eurozone economy saw its industrial output dip more than expected in June, down 1.3%. This was driven by a big dip in Germany and weak consumer goods production. However, overall GDP grew by 0.1% in Q2, which aligned with preliminary estimates. So it suggests some resilience to trade tensions, maybe, though the underlying trend in manufacturing appears weaker than initially thought.
It's a truly mixed signal for the Eurozone, isn't it? Shows some underlying weakness in industrial activity, despite holding GDP steady for now. It begs the question, how long can that resilience last if industrial output keeps sagging? Meanwhile, down under, the Australian economy showed some more positive signs. CNBC reported its unemployment rate eased to 4.2% in July, seasonally adjusted. That was in line with estimates, lower than Jane's 4.3%. The number of employed individuals rose by 24,500. Aussie dollar actually rose on this data, reflecting market confidence.
Good news from Australia, then. And on a somewhat, maybe personal note from the financial world, a very familiar name has shifted positions on a prominent list. CNBC reported that Warren Buffett dropped out of the top 10 richest people in the world, according to the Bloomberg Billionaires Index. This comes as shares of Berkshire Hathaway have lagged a bit in performance since his retirement announcement back in May. It's interesting how a single announcement can have such an immediate, tangible impact on wealth rankings.
It really is. And this raises an important question for you, the listener. How do these individual data points, from JD.com's earnings to India's IT job cuts, European industrial output, Australian jobs, even the wealth trajectory of a titan like Warren Buffett, how do they paint a composite picture of global economic health right now? It highlights the ongoing tensions, doesn't it, between underlying growth, policy decisions, various headwinds, and it reminds us economic narratives are always evolving. And leadership transitions, like at Berkshire, can have real financial consequences.
So, okay, after diving deep into all these interwoven narratives, what does this all mean for the broader market outlook? Potential strategies for investors? Wolf Research, as reported by CNBC, believes the fundamental stock market backdrop remains robust. Why? Due to a solid earnings season and that strong AI spending narrative we talked about? That certainly sounds optimistic.
And that optimism is clearly reflected in current trading strategies. Bloomberg reported that UBS recommends an options pair trade for the S&P 500, essentially betting on a slow and steady grind higher.
Mhm.
This strategy perfectly reflects the current market sentiment, right, where the SIBO Volatility Index, the VIX, often called the market's fear gauge, has dropped to its lowest level since Christmas Eve. This suggests hedgers are abandoning pessimistic positions. It indicates a general expectation for continued, albeit perhaps gradual, market gains.
That VIX strike is certainly a telling sign. Reduced fear in the market. But as you always remind us, there's always a bigger picture, always potential catalysts for sudden shifts.
Exactly. And if we connect this to that bigger picture, while there's clear optimism, a key risk looms on the horizon. Federal Reserve Chair Jerome Powell's Jackson Hole Economic Symposium speech, that's on August 23rd. A hawkish tone from him, any unexpected guidance, could suddenly shift market expectations. It could really challenge that slow and steady grind narrative. And it could create significant volatility, even if options markets right now are pricing in a relatively small implied move for the day of the speech itself. It's a definite watch out.
That's a powerful point for us to leave you with today. We've seen markets reacting to hopes, right? Hopes of rate cuts, the undeniable surge in AI-driven demand, all while grappling with unpredictable tariff policies and these mixed global economic signals. So here's a provocative thought for you to consider. What happens if the market's current narrative, this slow and steady grind higher, encounters an unexpected jolt, either from central bank policy, like Powell's speech, or maybe escalating trade tensions? How much of the current optimism is built on solid fundamentals versus, well, a collective belief in a particular desired outcome, something to mull over? That wraps up another deep dive into the complex world of finance. We hope this exploration of today's major headlines has given you a clearer picture and some valuable insights. We'll see you all tomorrow morning with new headlines from major financial magazines.